Welcome to the Ellis Martin Report and Money Talk Radio. I'm Ellis Martin, and today I'm pleased to be joined by Matthew Blumberg and Zach Maurer of Prairie Lithium, trading on the ASX as PL9 and in the US on the OTC as AZLAF, an Australian lithium brine developer advancing a major project in Saskatchewan, Canada. Prairie Lithium is focused on unlocking large-scale lithium resources through direct lithium extraction, or DLE, an innovative technology designed to efficiently separate lithium from subsurface brines while minimizing environmental impact. Matthew Blumberg brings a background in engineering, commerce, and private equity, while Zach Maurer, founder of Prairie Lithium, adds deep hydrogeologic and energy sector expertise. Today we'll discuss their DLE process, development roadmap, and how Prairie Lithium aims to strengthen the North American lithium supply chain. Gentlemen, welcome to the Ellis Martin Report.
Thank you so much for having us on the show, Ellis.
I've done some research on your company, and I have to tell you, the lithium space has been tough for junior mining companies. There's a lot going on in Ontario. There's a lot going on in the province of Quebec. Most of it's hard rock. In this country, in the U.S., we had a bunch of companies that were attempting to do business in the Clayton Valley, and they're gone. The water issues over there, all of that. And then the only company that really stuck around in my head over the years, because I pretty much followed them from conception to where they're at today, is Standard Lithium, operating in Arkansas. And they've got to deal with Lanxess over there for direct lithium extraction. Their stock is probably $3 US, maybe $4 Canadian. You're in a similar zone, aren't you, with regard to the business? Because I think the only safe bet for juniors at this point is direct lithium extraction. Gentlemen?
I think that's right, Ellis. The lithium market's a very interesting one because it's still very small. It's only 1 to 1.2 million tons a year of supply and demand. And so just a small bit of extra supply or lower demand than what was expected, that can really move that market and move that price. And so what we've seen is certain companies that have good projects, that have okay projects, have invested in their projects and come at it at a time when they're not seeing that return on investment because they're ramping up too fast and as that price is coming down. What we've done is we've been prudent with our capital so that we're only developing it at the speed that we can raise the funds and that we can essentially do it in a way that's going to maintain our balance sheet and maintain our liquidity. And you've been sitting tight, but yet making inroads forward.
To speak a little bit to the market volatility and players entering and exiting the space, our project was around before the last bull run. We were capitalized privately until the acquisition by Arizona Lithium to be publicly listed on the ASX. But obviously with the price run in lithium in late 2021 into 2022, you did see a lot of juniors try and add a lithium project to their portfolio. And since then, with the price fall off, a lot of them have pivoted back to uranium and gold. But there still are a lot of tried and true lithium projects still around, notably us. You mentioned Standard Lithium in Arkansas. And then speaking to your other point on water rights and different project development hurdles, obviously not a lot of junior exploration companies have the opportunity to actually go into production, given those project development hurdles that exist, whether it be water rights or regulatory permitting issues or access to electricity or other infrastructure. And I think that's where our project, being in an oil and gas producing region, is really going to stand out. And like you said earlier, very similar to what Standard Lithium is doing on a brine play down in Arkansas.
Did you know to go to Australia, to go to people like Matthew, to get the financing that really nobody else could get?
We knew developing the project privately that we needed to access the public market. That was a number one demand that we were hearing from investors, shareholders was, number one, we need to access the public capital markets to get the access that we need to continue to develop the project and also provide liquidity for long-term shareholders. So yes, we knew we needed a liquidity event. We knew we needed to get the project public. And then in meeting Matt and the team in West Australia, it was really just a perfect combination of events.
And Matt, what was your motivation here? Did Zach approach you, or were you looking for something in the lithium brine space in North America?
So we set out to find world-class lithium resources in North America. We've had positions in Arizona and New Mexico. We've looked at a lot of different companies and a lot of different assets. The fantastic thing about the Prairie Lithium project in Saskatchewan is the permitting environment or the permitting framework. So to put it in perspective, the project we had in Arizona, that was Bureau of Land Management land. And we would apply for a permit to drill and essentially see what we have there or expand what we know that we have there. And it would be 6 months before we'd get a reply. Then we'd be told we need to submit documents. Then it'd be another 6 months. There was always delays, always issues, always things coming up. With Saskatchewan, Zach would apply for a drilling permit and he'd get it 8 hours later. So it was just a remarkable difference and something that we identified. So we did our diligence into the resource. We liked what we saw. And when we came across this permitting framework, we just thought this is a project that can really be brought to market quickly and can really fill the required North American supply.
How did you secure the equivalent of 539 square miles, or let's say close to 800 kilometers of land in Saskatchewan?
I'll have to rewind to this one a couple of years. So my experience and my background is geology and oil and gas. So when I graduated with a geology degree, the price of oil was not great. The semester I graduated, the price of oil was $28 a barrel. That was the spring of 2016. So I immediately needed to apply my geologic skills and my knowledge of the subsurface to a different resource. And lithium was a resource that I really found quite interesting. So I started to just try and better understand the origin and evolution of lithium in brines in southern Saskatchewan so that we could high grade certain areas and really try and understand what the economic potential of lithium in brines in Saskatchewan could be. Ultimately, evenings and weekends, pulling in all the available public oil and gas data, partnering with experts in the space. Ultimately, we were able to high grade some specific areas that we felt had the highest potential for lithium brines in Saskatchewan. And then we were able to raise capital privately here in Saskatchewan to start to acquire that mineral acreage in 2019. So in terms of how we put together such a large mineral position was because we were ahead of the curve. By the time the bull run really hit in late 2021, 2022, we had already amassed 350,000 acres of subsurface mineral permit. So by the time the market was really queued on to lithium, we were already in a position where we had held a massive land position. So we didn't have to go out and compete for that land position. So we were able to acquire our mineral rights quite cost effectively before the real rush hit.
So you weren't really chasing share price during all that time. You couldn't have been. You were chasing production.
Yeah, as a private company and operating in the oil and gas industry here, we were absolutely chasing production. Our sentiment in developing the company was the best way to increase value is to sell lithium. So our number one focus on this project has always been, let's get it into production and the value will be realized.
You're not sending anything to a refinery, are you?
This is where our project does differ a little bit from other projects in the market in the fact that we will be producing an intermediate lithium product on our pads. Now, we have the optionality to build a battery grade conversion facility as part of our project if we choose in the future, but we're starting to see that midstream lithium market be built out where there are refinery projects being proposed in the United States, as highlighted by our recent announcement with Stardust Power, where they will actually offtake our intermediate lithium chloride product and then they would refine it to a battery grade carbonate in the United States. To date, the traditional model is that the miners do the battery grade conversion process typically, or an intermediate product gets filtered through China where the battery grade conversion process happens in China. But we're really starting to see the domestic push in North America where projects might be allowed to produce an intermediate product like a lithium chloride from our project and be able to sell it into North American refiners or refiners elsewhere in the world.
Where are we at with the facility? I understand that's going to start happening in January, this coming January. Is that correct?
That's correct. We released our pre-feasibility study on the project in late 2023, and that basically identified 3 commercial facility extraction locations. We then spent 2024 acquiring, securing, and drilling out those initial 3 locations. We've put our core focus into our first facility location. That's a location that we call Pad 1. So that's the location where our current development is happening. On Pad 1, what we did last year was we drilled out our initial production well. We drilled and tested our production well. We drilled and tested our disposal well. We have all the well infrastructure that we need on Pad 1 to support the resource production and disposal parameters. 2025 was really dedicated to taking that data that we got in 2024 from our pump testing and our DLE testing from the actual location where we'll be building the facility and finalizing the facility design and path forward. So we did release our phased plan in early 2025 that basically highlighted how we will establish production and how we will continue to grow production from across our project thereafter. In terms of where we're at with facility construction today, Yes, we have started the pad work for where the facility will be located. We have to do the dirt work before everything freezes up here in Canada. So we get the dirt work all set, and then we'll continue with the foundations work and we'll see the physical building itself being constructed in January 2026. It's important to note that the first commercial scale direct lithium extraction unit has also been in fabrication this year in 2025 and is anticipated to arrive in early 2026. So it's 4 commercial scale columns. And the reason we've chosen to go into production at this size is because 4 commercial scale columns can fit onto skid, which can be transported on a truck. The first commercial scale unit that can simply be replicated as opposed to having to make the columns go bigger or taller or wider. This skid mounted unit with 4 commercial scale columns on it can simply be replicated at this point. The oil and gas background, I like to use the analogy of, this is the first pump jack and heated treater. Once we de-risk the first pump jack and heated treater, we can simply replicate that process by drilling more wells and deploying more direct lithium extraction equipment on site.
So you're going to be stepping out eventually. I don't know how many years that's going to take, over the 345,000 acres.
That's correct. So go into production on pad 1. We'll scale up on pad 1 itself to maximize production there. We'll replicate that process on our next 2 pads that are already secured and partially drilled out so we understand the resource parameters. And then as part of our drilling program last year, we were able to identify an additional 7 commercial extraction locations that we'll pursue in the future so that we can monetize the entire project area.
So I'm guessing, and it's only a guess, that you're not lining yourself up for any future M&As. You are going to bring this company into production, continue to run it.
Well, again, I think our mantra is if we focus on doing what's right for the project and getting the project into production, opportunities will present themselves. But our core focus has to be on doing what's right for the project and making sure that we're progressing the project towards production to realize what its full value could be.
Just to put it in perspective, so each pad is 2,000 tons per annum of production approximately. So 10 pads that have been identified on our land holding, and there likely would be more, but the 10 that we've identified, that'd be about 20,000 tons per annum of production. And so if we're assuming a $20,000 per ton long-term lithium price, which is generally where the forecasts are at, between 20 and 22,000, that's a significant amount of revenue and a significant amount of annual sales that we'll see from each of those pads.
What kind of money is that, and when does that begin?
So it'll begin straight away as we bring the first pad into production. We're doing 2,000 tons per annum, and we're able to get that built in the next, call it year and a half. That'd be 40 million or so of revenue. And then once we get all 10 pads up and running, which would probably be like on a 5-year time frame, that would be 400 million in annual revenue. And so each pad costs us about 70 million to bring into production as a total installed cost. And as much as capital allows us to bring them online, we'll bring them online, and the margins are very high. Our cost of production is very low. A couple of other things that are interesting to note is this is an oil and gas region. They've been producing oil and gas out of the Williston Basin for 80 to 100 years. And so all the infrastructure is in place. All the service providers are there. All the fabrication shops are there. Everything's in place, ready for us. So by entering into this market as an oil field brine player, we really have a set up infrastructure. We're not trying to build out like a whole new town or anything like that, which some other projects would need to do. So we're very excited about it.
As a financier, let's just call you that for the sake of this broadcast, Matthew.
You can call me that.
Good. You could have gone anywhere in the resource sector. You could have gone into mining for rare earths. You could have gone into precious metals or base metal mining. Maybe you'd have a mine in 10 years. Maybe not. You could have gone into the oil and gas business, and that sector is kind of problematic right now. I think it's a great sector. We all need it. It's not going away. But you selected something that within short order, within 2 to 5 years, is going to potentially bring you anywhere from $40 million to $400 million a year. That's a fantastic return on investment that's rare in the resource sector.
So I guess the biggest difference between, say, the oil market or the copper market and the lithium market is the oil and copper markets, they're very, very mature markets. I totally agree with you. I don't think oil's going anywhere for a long time. The bull case growth in oil, in annual growth, is 2 to 3% per year. The lithium market, on the other hand, it's still in its infancy. The bull case growth assumptions are 20 to 30% a year. And so when you take a small market that's potentially got demand growth that's going at 20 to 30% annually for a significant amount of time, as EVs get adopted, as we get more storage products, as we get into lots of other industries too. It's just an amazing opportunity to enter in at the ground level and then grow with that growth.
Battery technology is changing. Energy storage technology is changing. Sodium chloride batteries, there's a variety of different avenues. How do you see the sustainability of lithium over time?
You're right. There's always somebody trying to build a better battery, and it's important to separate the noise from what's actually happening. So when it comes to battery chemistries, energy density is king. You want as much energy density as you can in the smallest product possible. And what that leaves you with is lithium. The mecca of battery chemistry looks like it's going to be lithium solid state. I'll talk about that in a couple of seconds here, but if we go back to your point on sodium ion batteries, based on everything that we can see right now, if you have the same size of battery and one is a lithium ion battery and the other one is a sodium ion battery, the lithium ion battery will substantially outperform the sodium ion battery because of the energy density characteristics. So when it comes to electric transport, we definitely see lithium as being the king metal going into the batteries themselves. Now, what does the future of lithium battery chemistries look like? Again, it looks like it's going to go solid state within the next decade. There's some significant attempts to having it go solid state within the next decade. And that, again, that's the beauty of our process, is the fact that solids inputs to a solid state battery chemistry are actually what we can produce at a lower cost on our project, being an intermediate lithium product as opposed to having to go to a specific battery grade product. And I guess the second key point to note is the retooling of supply chains. So we've seen, I don't know what the exact figure is, but let's call it hundreds of billions, if not trillions of dollars going into this push to electrify transport and energy storage and all these systems. And all of that is being built out with the lithium supply chain. So in my opinion, I don't think we get a mulligan to retool the supply chains to a different battery chemistry, given the fact that however many hundreds of billions have already been sunk into this current supply chain and are being built out around lithium battery chemistries.
I'll just add to that, the energy density is an important component of that, where lithium is far more energy dense than sodium. But in terms of solid state versus regular batteries, batteries generally have a cathode and an anode. And in solid state, you've got lithium in the anode as well. So we often get the question, what's going to happen to the lithium market? What's going to happen to lithium demand if solid state batteries take over? Well, actually, that'll drive even more demand for lithium as we move that way.
How do you see your relationship with regard to China and offtake during the next 5 years?
Yeah, we've seen, I would say, a significant demand for our product, not just here in North America as these supply chains are being built out, but also we traveled into Japan and South Korea a couple of months ago to go meet with potential off-takers firsthand and hear what they're thinking. And I would say that there's definitely a sentiment where jurisdictions want to ease their reliance on Chinese supply of lithium. And that can obviously be problematic because China does control over 80% of the lithium processing capacity right now. So it plays to our benefit in terms of developing a domestic lithium resource as these countries are looking to ease their reliance on Chinese supply.
I would think that Japan and South Korea and some of the end users over there could really just jump in and take all of your offtake if they wanted to at some point.
Yes, they definitely could. They definitely have the ability to. Yeah, it's an interesting one. We get inbound requests from China quite regularly, but there's a whole kind of ecosystem that we have to make sure keeps ticking over. And so a lot of the Australian resources have been committed to China. A lot of the South American resources have been committed to China, and they've built this position where, as Zach says, they're refining more than 80% of global material. The next push is, in this next phase of lithium growth, is to come up with some sort of a competition for China where they don't completely control the system. And so whether that's Canadian resources supplying American refineries or Canadian resources supplying Korean or Japanese refineries, we've spoken to Vietnamese counterparts, or whether it's American resources supplying American refineries, there's a lot of potential options. But I think geopolitically, it's a good move to make sure that there's enough competition there that no one group or no one country completely dominates the market.
We're just getting started here after probably 20 years of bumps and grinds in the lithium sector. We're just getting started, and it's going to be good, isn't it?
It is. We're excited.
Gentlemen, what would you say to American investors listening to your story for the very first time, or any investor anywhere in the world, about the potential opportunities with regard to Prairie Lithium?
Yeah, I think to summarize, we've got a large resource, 4.6 million tons lithium carbonate equivalent in the ground. Yeah, that resource is in a jurisdiction with a regulatory framework where it can be developed. And that resource is also overlain by all the infrastructure and skills that it needs to develop it. So we've got power lines, primary highways, railroads, all literally running right across our project area. We've got the drilling rigs, the service rigs, the trucking companies, the welders, electricians. So what you've got is this massive resource in a jurisdiction that it can actually be developed, and with the workforce and utilities to develop it. We're very optimistic on the ability to get our project into production here in the coming years and continue to grow that production from across the project base.
And Canada still sees the US as its big brother. Canada is invested in the US's success. And I think this is a terrific project to bring the countries together, where you've got a Canadian resource that's supplying batteries that are getting built in the US for US consumption and US manufacturing. And yeah, in terms of the price that you can get into the company at compared to what its intrinsic value is with the resource that we have under the ground, it's a really strong risk benefit analysis. We think this is a great investment opportunity.
Zach, as you stated, your background's in oil and gas. How is this direct lithium extraction similar to oil and gas?
So the important thing to note about oil and gas in Southeast Saskatchewan is it's actually a brine mining industry. And what I mean by that is our oil and gas wells typically produce 95 to 98% water cut. So what that means is at any given time towards the end of an oil well's life, 95 to 98% of the fluid coming out of that oil well is brine water. So how it relates to our direct lithium extraction project is when they're drilling for oil, they're actually drilling for mostly brine water. They get skim oil on the top. When they're producing that oil to surface, they're processing primarily brine water. And the number one thing that they're disposing of in the oil and gas industry in southern Saskatchewan is brine water. So in terms of how it's similar, it's pretty much identical. We use the same drilling rigs, the same drilling techniques. We use the same completion techniques. We do drill into different formations because we try and avoid any hydrocarbon or any oil in our well bores. But in terms of the drilling, producing and processing and disposing of the fluid, we aren't doing anything new in terms of what the oil and gas industry has already done. Where the newness happens, and that's around the direct lithium extraction technology itself. So in the oil and gas industry, they bring that emulsion to surface. They skim off the oil. In our process, we bring the lithium brine to surface and we extract the lithium. So overall, from a resource development and operations perspective, it's nearly identical to what's already being done in the oil and gas industry here in southern Saskatchewan.
Is this only exclusive to Saskatchewan, or could you, let's say, go to the DJ Basin and work a deal with one of the oil companies over there?
Typically, oil fields in North America have a high water cut. It's going to vary from oil field to oil field and formation to formation, but typically conventional oil and gas production in North America will be associated with a high water cut.
Tell me about your team. Are they as ensconced in the oil and gas business as you are, Zach?
Yeah, our primary hiring pool is out of the oil and gas industry. It's also worth noting that we've got a pretty massive potash industry here in Saskatchewan, so we draw on talent from the oil and gas industry and the potash industry.
Well, there certainly has to be some potash on your 345,000 acres, right? What are you going to do with that?
Yes, we do own the subsurface mineral permit to the Prairie Evaporite Formation, which is the primary potash producing formation here in Saskatchewan. So we do have that.
We're introducing several, as you probably know, ASX companies that trade on the OTC to our audience right now. And if you're typical American investor, you're looking at the float, you're looking at how many shares you have out there, and you're going, wow. If you're a day trader, you can buy in the dips all day long and make money. And that provides liquidity for the company. And once you're starting to bring in that revenue, a stock that's a micro stock like yours can really bring in that 5, 10, 20 banger down the road. For the long play, it's good as well.
So I guess by having a large number of shares that are outstanding, the difference in the bid and the ask is much smaller than if you've got a much smaller float or a much smaller amount of shares that are outstanding. So if you've got 200 million shares outstanding and the company's trading at 10 cents, it may be between 10 cents and 10.5 cents with the bid-ask spread in order to be able to hit that. And the percentage difference between 10 and 10.5 is not a huge percent. But if you've got 4 billion shares outstanding or 4.5 billion shares outstanding, if the shares are trading between 0.7 of a cent and 0.8 of a cent, the difference percentage-wise from 0.7 to 0.8 is significant. And so just by trading it in between that range, you can make approximately a 15% return on that trade. We prefer the long-term investment strategy where we think the shares are significantly undervalued and in the long term will hopefully move to their intrinsic value, which will be multiples of where it is now. But I take your point that you've got this large float where you're able to trade in and out at small increments, which percentage-wise are big increments. Like if people want to be buying and selling and then maybe they start to learn the story and maybe hold on to some.
Well, Matthew Blumberg and Zach Maurer, it's been a real pleasure getting to chat with you. I look forward to another conversation in the coming weeks. Thanks so much for joining me today on the program.
Thank you for having us, Ellis. It was great talking to you as always.
I've been speaking with Matthew Blumberg and Zach Maurer of Prairie Lithium, trading on the ASX under the symbol PL9 and in the US on the OTC as AZLAF. To learn more about the company's projects and its direct lithium extraction technology, visit prairielithium.com. I'm Ellis Martin, and you've been listening to the Ellis Martin Report on Money Talk Radio.